Hey guys, what is up? It's Arthur here, and today in this video we're taking a look at Microsoft, one of the biggest companies in the world, and we're going to see how they measure up against our 10-item checklist and whether there is any potential with this stock. So right off the bat, $2.85 trillion company, one of the most valuable companies in the world, roughly the same market cap as Nvidia, slightly bigger and about 10% away from Apple, one of the biggest names. So if you don't know what Microsoft is doing, they develop and support software, services, devices, and solutions, productivity, business processes, cloud solutions, and personal computing. They also have LinkedIn and other various sources. You might know the Xbox gaming console. And the first metric that we want to look at is their 5-year revenue growth, which you can find in the financials. We are using MarketWatch for this. Income statement, very first line, we went from 143 billion all the way up to 245 billion, which is insane. It's a very nice, stable, linear growth. Look at that graph. That is what we like to see. Constant, almost around 15% growth every year. So that is a massive check mark. And there is a graph, a chart showing where this revenue is coming from. So we can see that Microsoft Azure, I don't know how you pronounce that, we pronounce it Azure, is the biggest source of revenue, which is their sort of cloud solution. And we know how cloud has been growing quickly, so we can see this. I assume it is going to grow even bigger and in a faster pace than the rest. So Microsoft revenue is shifting towards cloud solutions. They also have Microsoft 365, which is the renamed version of the Office and all the related tools like Excel and Word and all that kind of stuff. They have the Windows 11, the operating system, LinkedIn, Xbox, and Copilot, and all the others. So this is how the revenue is made up. And if we scroll down, we can see how much of that remains once you find net income, which is up from 44 billion to 88 billion, a double in 5 years, which is amazing for a company of this size. So give them credit for that. There was one stable year where was no growth, but in the end, it's again a very, very nice trend, sort of very more of a predictable line of growth. And then next up, now that you know the average of this net income, which is 67 billion, as you can see on the card that I just revealed, you can take this number, go back to the market cap of 2.85 trillion, take this number divided by your average earnings, so you don't take the net income, it's the earnings that you take. And once you divide the market cap by their average earnings, which is the net income, sorry for that. So yes, you take the market cap 2.85 trillion divided by the net income, also known as earnings, and you get a price to earnings ratio, which tells you if you buy this company at this price, 2.85 trillion, or you can talk in terms of shares, 381 per share, it's going to take you 42 years with these current average earnings numbers to make your money back in this company, which might be low, might be high. We are looking for a value below 20, but different industries have different values, and based on the growth potential in a company, there might be a premium that you have to pay for a company. So far, the growth that we have seen is very nice, so it might deserve a premium. We got to see the rest of the items on this checklist, and you got to do more research on this. But what I like to do is look up the peers, the competitors, what they are selling for, and so we get a better idea of where Microsoft's valuation and price is in compared to those. So once we do that, we see that the peers are actually selling for 48 times earnings, which makes Microsoft slightly cheaper than the rest. So even though you are paying a high premium for this company, it's still somewhat lower than what you would pay for others, which is very interesting to see. Now, return on invested capital is up next. So for every dollar that gets put into this business, what is the return that they are gonna earn on that? Once you calculate that, it's 24%. Market average is 9 to 10%. So it's more than double the market average, which is phenomenal to see. And companies who can earn a high return on invested capital usually have some staying power. They are integrated into the lives of people and the everydays. And this is what creates that moat around them that everyone talks about and makes it a little bit harder to get rid of them and for them to stick around. It is easier for them to stick around. Now, one thing I wanted to mention about return on invested capital, this is, I believe, not a GAAP or valuation standard metric, so this is not generally accepted. There is no set definition, so there are multiple ways to calculate it, and different sites use different values. If you're interested, I could share what is my calculation, but just know that you might find different values on different websites. So next up, we want to figure out how many owners we have to share this profit with if we buy this company. And you can find it in the income statement. Once you know what is the earnings or net income that is left, you got to scroll down and you can see how many shares there are to essentially share these profits. So we can see that we are down from 7.68 billion to 7.47 billion. Not much of a decrease, 2.7%. The tendency is nice. We don't see them effectively issuing more shares. So as you can see, this value is down from last year. So is this, so is this. This is the same. So as long as we're not issuing shares, that's good practice. We want this number to decrease, so that's a check mark. It is happening, not a very quick pace, but we are buying back shares as Microsoft, so that's good to see. They are rewarding shareholders by making them bigger owners of this business. Now we want to see where the revenue growth is coming from, right? So you can see how revenue has grown. We want to find out if this is due to taking on more debt, which is very easy to make more money with, or this is due to their good management or good sales practices and just generally a mark of a good business. So once we do that, we can see that long-term liabilities over the 5 years grew 6.96%, almost 7%, while revenue, as you can see on the very first card, grew 71%. So this is massive. This is a very nice thing to see. They took on proportionately a lot less debt compared to how much revenue they could generate. So this is very nice. And if you want to calculate it on your own, you can go to the balance sheet. One side of the balance sheet, I show it to you on the camera. One side of the balance sheet is assets, and on the other side you have liabilities and shareholders' equity. And so basically the asset side tells you what the company has, and the liabilities and shareholders' equity side combined tells you how they can afford that. So where does the money coming from to buy and own all the things that they have? So if you want to calculate long-term liabilities, you go to liabilities, you take total liabilities and deduct the current liabilities, so you are left with the total long-term liabilities, which is not going to be written, but you can calculate it by doing this simple subtraction. All right, revenue growth is just that, so it is a massive check mark on this front. And we can go on to the cash flow statement, where we want to find out the 5-year free cash flow. How much money is left after all the business matters are done. Free cash flow is net operating cash flow plus the minus value of capital expenditures. So it's just going to be basically the difference of the two absolute values. You're going to take this, add this minus, plus minus is minus, so 60.6 billion minus 15.4 billion, that's going to be like 45.2 or something. You do this for all the years and then you can average that out. There is also a free cash flow line which just gives you that results. You can average that and that would give you on average $60 billion. We are also up from 45 billion to 74 billion. That's a check mark and a growth of 63%. It is also a very nice growth. There was a little dip here, but all in all, it would make for a very nice growing trend line. All right, so now that you know your free cash flow average and how much of money is left in the business every year, you can take that money and take the money value and see how much time it would take to pay off those long-term liabilities that you just calculated from the balance sheet. Because you can take the last year, now that you've learned how to calculate it, you can take the total liabilities from the last reported year or the past trailing 12 months, and you can deduct the last year's total current liabilities to get the total long-term liabilities, for the last year, which just eyeballing it looks like 120 billion roughly. And you would divide that by the amount of free cash flow on average that you generate to get a number that tells you how many years it would take the company to pay it off. In Microsoft's case, it's 1.97, roughly 2 years. We would want this to be under 5 to give this company a nice, comfortable position to do whatever they want with the money, because with free cash flow you can do 5 things. That is, pay down debt, as I just showed you. You can buy back shares, as we talked about. You can pay a dividend, and you can buy another company or just reinvest in the business. Talking about dividend, I want to show you this little dashboard I'm working on. So we can see that they do pay a dividend amount. This is how much you would get on 1 share. So you got to multiply that by 4. So you get the forward annual dividend, which is assuming the dividend is going to stay the same. This is how much you get in 1 year. And if you divide this by the share price, you get that they pay a 0.8% dividend, which is growing about 9.5% every year above inflation. So that is, again, a good thing to see. It is costing them $23 billion to pay this dividend, and they have a free cash flow average that we calculated 60 billion, so they can pay it. If one ratio that I also incorporated here is called the augmented payout ratio. So to understand this, take the simple payout ratio and talk about that first. Payout ratio tells you how much of a percentage, what is the share of the dividends that they pay out, either from their net earnings or their free cash flow. Depends on how you want to calculate it. I trust free cash flow more than earnings, because earnings is easier to manipulate. So free cash flow wise, paying out their dividends, that's the payout ratio, what is going to cost them. The reverse is going to be the retention ratio, how much of the free cash flow is kept after paying out dividends. Now, if you go augmented payout ratio, which I like to use as a ratio of what percentage of the free cash flow is returned to the investors, because this takes into account the dividends that are paid and the shares that are bought back. And this is 71% of the company's free cash flow, which I don't know what is a good number. Back when I started investing, I heard that for a payout ratio, such as dividends, it's better if it's below 70%. So based on that, an augmented payout ratio around 70% looks good. I don't know what is the correct number. There's no correct number, because there is still money left in the business to pay down debt, buy other companies, and reinvest in the business. And so, yeah, this looks like a good number. I think there's a tendency that payout ratios are going down. So companies are paying out less dividends, because a company would pay out a dividend if it is sort of running out of meaningful investment opportunities, because paying dividends is not the most efficient thing that you can do tax-wise, and you would want to reinvest in the business in the first place. But once the company grows so big, meaningful investment opportunities start to dry up and reduce in numbers, so they start returning value to investors by paying dividends. And so as probably AI entered the scene and cloud is becoming a bigger and bigger thing, more and more investment opportunities might be opening up. So that could be an explanation why payout ratios are going down and companies paying out less dividends these days. I think that is a trend, like a graph or an article that I saw. So check on that to make sure. Anyhow, last metric that we want to check, now that we know what is our free cash flow average for the last 5 years, which was 60.01 billion, we can take again the market cap of 2.85 trillion and divide that by this free cash flow number. So we get that the price to free cash flow is 47.49, slightly higher than our price to earnings. So what this means, it is an X because we want it to be below 20, but if there is growth, you might be paying a premium on this. Whether this premium is worth it, I don't know. It's for everyone to decide. What I can tell you what this number means. It means that if the free cash flow is going to stay the same, 60 billion is going to stay, so assuming no growth, but if the average is going to stay 60 billion, it's going to take you 47.5 years for your money to make it back in the company. So let's say you buy the whole company for $2.85 trillion. You're going to be 100% owner of Microsoft. You pay that price. It's going to take you 47.5 years to make your money back in free cash flow, with which you can reinvest in a company, buy another company, pay debts, issue a dividend, or buy back shares. You're not going to do that from yourself probably, but generally those are the things that you can do. So that's how you sort of make money in a company, or like create value, make it more valuable. And so you can see that taking 47.5 years to make a return of like 100% return on your money, not even 100%, just like make it back, is a very long time. So there are better investment opportunities out there, but this is not taking growth into consideration. So make sure that you do your accounting and calculation on that to see where the growth numbers would take you and how that relates to paying this price to free cash flow price today. I'm working on a discounted cash flow model, which can project these free cash flow streams into the future, with which you can make a discount to today's prices and values. And so we can put a price on a company. So I will try to include that in my future stock reviews. If you have any companies that you would like to see reviewed, leave a comment down below and I will help you out with that one. And if you have any thoughts on Microsoft, where it's going, what are the pros and cons, also leave them in a comment. I'm very happy to talk about it and consider them for future videos. I think that's it for Microsoft, scoring an 8 out of 10. I think this stock has potential, but you got to do more research and see where those valuations are going to be with the growth numbers to see if you are getting a good deal. Because even though there is growth, if you still overpay for a company, it's not going to make you a good enough return, and your money could be better spent elsewhere. So do your research, and I thank you for your time watching this video, and I hope to see you in another video. Thank you. Bye.